Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we are diving into one of the most powerful forces in modern financial markets. It's something that consistently moves stocks, bonds, and crypto in dramatic ways, often within seconds. And yet, it's something many traders still don't fully understand. Today, we are talking about CPI. Specifically, how CPI reports move stocks, bonds, and crypto, and how you can build a practical, disciplined CPI report trading strategy instead of reacting emotionally every time inflation data hits the headlines. If you've ever opened your charts on a CPI day and seen markets spike violently in both directions, you're not alone. CPI releases can feel chaotic, unpredictable, and stressful. But once you understand what's actually happening beneath the surface, CPI stops being random noise and starts becoming one of the clearest macro signals available to traders. Let's start by grounding ourselves in what CPI really is. The Consumer Price Index measures changes in the prices consumers pay for a broad basket of goods and services. That basket includes essentials like housing, food, energy, transportation, medical care, and everyday items people rely on. CPI is released monthly and comes in different versions. There's headline CPI, which includes everything, and core CPI, which strips out food and energy because those prices can be volatile. You'll also see month-over-month readings that show short-term inflation trends and year-over-year numbers that show the bigger picture. But here's the first thing every trader needs to understand. Markets don't trade CPI in isolation. They trade expectations. Weeks before the CPI report is released, economists publish forecasts. Traders position based on those forecasts. Hedge funds, banks, and institutions place bets on what they believe the number will be. By the time CPI is released, much of the market has already committed capital based on what it expects to happen. That means the real driver of price movement is not whether inflation is high or low. It's whether inflation is higher or lower than what the market already priced in. That gap between expectations and reality is what causes explosive moves. CPI matters so much because it directly influences central bank decisions, especially decisions around interest rates. Inflation is the Federal Reserve's primary concern. When inflation runs hot, the Fed tightens financial conditions by raising rates. When inflation cools, the Fed can pause or eventually ease policy. Interest rates affect everything, from mortgage costs and business loans to stock valuations, bond prices, currency strength, and global liquidity. This is why CPI doesn't just move one market. It moves all of them. Let's talk about stocks first. Equity markets are highly sensitive to CPI because inflation shapes interest rate expectations, and interest rates shape how stocks are valued. When CPI comes in hotter than expected, traders immediately start pricing in higher rates or a longer period of tight policy. Higher rates increase the discount rate used in valuation models, which reduces the present value of future earnings. This is especially painful for growth stocks and technology companies. These businesses often generate most of their expected value far into the future. When rates rise, those future earnings become less valuable today. That's why, on hot CPI prints, you often see sharp sell-offs in tech-heavy indices like the Nasdaq, while broader markets turn volatile. On the flip side, when CPI comes in cooler than expected, stocks often rally hard. A softer inflation reading suggests the Fed may ease off tightening. That improves liquidity expectations and encourages risk-taking. Money flows back into equities, and you often see strong upside momentum, sometimes lasting days or even weeks. But CPI doesn't move all stocks the same way. Inflation data often triggers sector rotation. Financial stocks can benefit from higher rates, while consumer discretionary companies may struggle if inflation squeezes household budgets. Energy and commodity-linked stocks can rise during inflationary periods, while defensive sectors like utilities and healthcare may outperform when uncertainty is high. This is why a solid CPI report trading strategy in equities looks beyond index-level moves and pays attention to where capital is rotating beneath the surface. Now let's shift to bonds, because this is where CPI's influence is often the most direct. Bond markets are extremely sensitive to inflation because bonds pay fixed income. Inflation erodes the real value of those payments. When CPI comes in higher than expected, bond traders demand higher yields to compensate for inflation risk. As yields rise, bond prices fall, sometimes very quickly. When CPI comes in cooler than expected, yields often fall as traders price in less aggressive rate hikes or future rate cuts. Bond prices rise, and financial conditions loosen. The bond market often reacts within seconds of the CPI release, sometimes even before stocks fully process the data. That's why professional traders watch Treasury yields closely on CPI days. Bonds often act as a confirmation signal. If stocks are rallying but yields are rising, something doesn't add up. If both are moving in sync, the move has more credibility. CPI can also impact the yield curve. Depending on how traders interpret the data, the curve can steepen or invert further, signaling changes in growth expectations and recession risk. Ignoring bonds during CPI releases means missing one of the most important pieces of the puzzle. Now let's talk about crypto. Crypto markets have evolved into macro-sensitive assets. While Bitcoin was once marketed as an inflation hedge, in practice, crypto now trades largely as a risk asset, especially during CPI events. The key driver here is liquidity. When CPI is hot and interest rate expectations rise, liquidity tightens. Risk assets sell off. Crypto prices often drop sharply, sometimes even more aggressively than stocks due to leverage and thinner liquidity. When CPI comes in cooler and rate pressure eases, liquidity expectations improve. Risk appetite returns. Crypto markets can rally explosively, with short squeezes and momentum-driven moves. Crypto tends to amplify CPI reactions. High leverage, fast-moving retail participation, and less depth during news events make price swings more dramatic. This creates opportunity, but also danger. A CPI report trading strategy in crypto must emphasize position sizing and risk control even more than in traditional markets. So how do you actually trade CPI instead of just watching it? A structured CPI report trading strategy starts with preparation. You need to know the market's expectations before the release. You need to understand recent inflation trends and central bank messaging. You need to assess sentiment and positioning. Are traders already defensive? Is volatility elevated? Is the market complacent? From there, you choose your approach. Some traders prefer to trade the immediate reaction, looking to capture momentum in the first few minutes after the release. This requires experience, fast execution, and emotional discipline. Others prefer confirmation-based trading. They wait for the initial volatility to settle, then look for breakouts, reversals, or trend continuation based on technical levels and cross-market confirmation. Neither approach is inherently better. What matters is consistency and discipline. Risk management is non-negotiable. CPI releases can cause slippage, widen spreads, and false moves. Smart traders reduce position sizes, define stops in advance, and accept that missing a trade is better than forcing one. Now, none of this works without the right tools. Executing trades during high-impact events like CPI requires a reliable, intuitive trading environment. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, I strongly recommend checking out Crystal Ball Markets. You can explore the platform at crystalballmarkets.com/platform. It's designed to help traders stay focused, manage risk, and execute efficiently when markets move fast. If you're serious about applying a CPI report trading strategy in real market conditions, this platform is worth your time. Education matters just as much as execution. CPI is not a one-time event. Inflation trends evolve, and understanding them requires ongoing learning. If you're looking for beginner-friendly podcasts that cover trading, investing, macroeconomics, and financial markets, I highly recommend checking out the Crystal Ball Markets podcast series at rss.com/podcast/crystalballmarkets. These episodes break down complex topics in plain language and help you build the kind of market intuition that separates reactive traders from prepared ones. Subscribe and make macro learning part of your routine. Before we wrap up, let's talk about mistakes. One of the biggest mistakes traders make around CPI is trading without a plan. Volatility triggers emotion, and emotion leads to bad decisions. Another common mistake is overleveraging. CPI moves can wipe out oversized positions in seconds. Many traders also ignore bonds, which often provide early clues about whether a move is sustainable. And finally, confusing short-term noise with long-term trend changes can be costly. Not every CPI reaction reshapes the market narrative. So here's the takeaway. CPI reports sit at the center of today's macro-driven markets. They influence interest rates, liquidity, and capital flows across stocks, bonds, and crypto. When you understand how CPI reports move these markets, you stop reacting blindly and start thinking strategically. A disciplined CPI report trading strategy focuses on expectations, confirmation, and risk management, supported by the right tools and ongoing education. CPI doesn't have to be something you fear. With preparation, it becomes one of the clearest windows into how markets truly work. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia. Thanks for listening, and I'll see you next time.